Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hi, everyone, and thanks for joining. I'm Stephen Boland with Odlum Brown. When I tell people what I do, I often get asked, what stock should I buy? It's a natural question to ask, but I don't think I've ever been asked, what stock should I sell? Likewise, there are countless publications on what to buy and when, but much less is written on what and when to sell. Yet for every buyer of a stock, there is a seller. And selling stocks can have a really big influence on portfolio returns. So today we're going to talk about the art of selling. And joining me to do so is Stephen Zicherman. Welcome back, Stephen.
It's good to be back.
So I want to make a couple of points before we start. We're going to focus today on individual stocks. We're not talking about buying and selling in and out of the market as a whole. We believe in holding good stocks for the long term, not trying to time the market. And second, like many parts of investing, there's a lot of room for debate on this topic. There is as much art in selling as there is in science. But generally speaking, Stephen, what's a good framework for thinking about when to sell a stock?
Well, I'm really glad that you mentioned both art and science. And I want to add to the disclaimer that this conversation is not meant to be prescriptive. There is no single right way or wrong way. And I think when it comes to both buying and selling, you want to be flexible in your thinking and you want to avoid rigidity. So to answer your question, we really boil it down to three reasons why you want to sell a stock. The first one is to make a switch. And that's just simply you found something better in either price, quality, or both. That's the most frequent reason why we do sell a stock. The second reason is misjudgment. You discover that your thesis for owning a stock is simply just wrong. You've made a mistake in some judgment, perhaps on the fundamentals of the company or the management. And the last reason is overvaluation. This is when the price is too high and becomes an impediment to generating future returns.
So switch, it sounds simple enough. In practice, it's much more difficult. How do you think about stacking stocks up relative to each other?
We're constantly looking at relative value, both within sectors and across sectors. One of the best switch trades that we made that I can remember, and I think you'll agree with me, this was about a decade ago, was Visa for TransCanada Energy. These were two companies in different sectors trading at very similar valuation, but with very different growth and profit projections. TC Energy was projected to grow at an average rate, while Visa was projected to grow at a well above average rate. So it was really simple to sell the one that was projected to be a slower grower for the faster growth and while maintaining the same price.
And Visa was a much more profitable company too, and still is. And it's an interesting example. And back then, as you mentioned, you were getting a much better company for a similar price. It's kind of interesting today in that Visa turned out to do a lot better than TC Energy. If we look at valuations today, Visa is actually trading at a much higher valuation multiple than TC Energy. So it's still a more profitable company, still has better growth prospects, yet the valuation gives us a little bit more pause today on whether Visa is more attractive than TC Energy. So consequently, we actually recommend them both today. So it's great when you get clear cases like that, but a lot of times it takes a lot of digging to figure that out. But if you find one that's clearly better than another, then a switch is a great reason to sell. So let's go to misjudgment. And you talked about that, making mistakes. And no investor is perfect. And we all wish that every stock we purchased worked out, but that's just not realistic. And even the legends like Warren Buffett make mistakes and learn lessons along the way. But how do you know when you've made a mistake?
Well, this goes back to the part about being fluid in your thinking. You don't know exactly when you've made a mistake. Usually you have a thesis. There are a number of reasons why you've judged a stock being attractive. Then a company will report earnings. They could have some disappointing results. and you're trying to understand whether the original thesis is still intact or whether you made a mistake or whether you've made an error in your judgment. Oftentimes, you could think about management and management quality. You think a management team is great, and then they overpay for an acquisition, which could possibly lock in lower future returns. But on the subject of judgment, I'm influenced by a book written by an author, Lee Freeman Shore, and the book's title is The Art of Execution: How the World's Best Investors Get It Wrong and Still Make Millions. How can you not love a title like that? The book, for me, I should say, challenges the belief that successful investing is all about picking winning stocks. Instead, the author would argue that it's behavior, not how you pick, but how you react to both winning and losing positions, that is a true differentiator. And it's interesting what the author did. He conducted a long-term experiment over a 7-year period where he allocated some money to 45 different investment managers, and he instructed them to invest only in their 10 best ideas. And surprisingly, what he found was that these elite investors were right, and I'm using air quotes, making money, on average less than 50% of the time, with some of them being right as little as 30% of the time. So despite this low batting average, if we can use a baseball analogy, most of them still made good profits. So what happened? Well, the author identified some behavioral patterns and how these investment managers handle their trades. And he categorized them into tribes. We'll get into some of the names of these tribes. But with respect to managers and losing positions, he came up with 3 different tribes. First one is rabbits. This was the least successful group of managers, and they did nothing in the face of losses, hoping for a rebound. Some people call this get-even-itis disease. And this inaction led to a pretty big capital loss in the future. Second group were assassins, and these were managers that cut losses quickly, often at some predefined level, and they really prioritized capital preservation and just moving on to new opportunities, new switch ideas. And the last group were hunters. This is the contrarian bunch. They added to losing positions when they believed that the fundamentals were still strong, and they didn't draw the conclusion that there was any kind of misjudgment. So when it comes to losing positions, you really want to be a hunter or an assassin in the eyes of this author. You want to be active. You don't want to be a rabbit. And just lastly, on the topic of winning positions, he described 2 tribes there: raiders, managers who tell them to sell really quickly. We all usually want to lock in quick profits at the expense of longer term gains. And then what he calls connoisseurs. These were successful winners, successful managers who let their winning positions run. Peter Lynch, the great Fidelity fund manager, once described that process as watering the flowers.
Yeah, that's a lot to unpack there. Let's maybe dig into that a little bit more. The example there that you gave around rabbits, assassins, and hunters. I think the message is when something goes down, do something. Don't just sit there. Now, is it possible that the answer could be maybe the best thing to do is just sit tight? I'm not going to add. I'm not going to sell. I'm comfortable with my position size. And maybe the act of forcing yourself to try to do something, the answer might be just stay the status quo. But does it necessarily mean action, or is it more about just the thought of, okay, I should revisit my original thesis here?
I think you just described that perfectly. There's no right or wrong way to do this. That's what makes it so difficult. Sometimes inaction is the right course of action, if I can put it that way.
Okay. And I think the idea as well that you referenced of the judgment and having to reevaluate your thesis. And at the end of the day, a lot of this just comes down to judgment. And sometimes you're right and sometimes you're wrong. But I'm thinking about an example here where we still actually recommend a company called Vertiv. And Vertiv makes equipment that goes into data centers. And we recommended the stock in, I think it was 2021 at, let's call it roughly $20. And within a year, management had really messed up when inflation took off. They didn't price their contracts appropriately. Margins got smoked. The stock went down. It went down to under $10. So you were down by half at that point. And there's an emotional element that comes in. It's easy to sit there and say, oh, well, this is down. This is a disaster. And in Vertiv's case, we looked at it and said, okay, we still like the company here. We still think the business has a bright future. Its competitive position is still strong. We really like the management team. Yeah, they made a mistake for sure, but we still thought there was a lot of talent there. And we decided to hold on. And there was a lot of people that really questioned that call at the bottom because they'd ridden the stock down. But thankfully, we held on, and the stock's actually over $100 today. And maybe that's a bit of an extreme example, but it's about really evaluating the facts at the bottom and not getting tied up in emotion and not just being dictated by the share price. You're neither right nor wrong based on the share price movement. You're right or wrong based on the facts and how you interpret them.
That's a great example, Steve. And that's often why we like to tell people you have to know what you own. Because when there is some gyration in the share price, if you don't know what you own, you're more likely to act on an emotional response. And when people are selling, it's easy to want to join the crowd and be a seller and vice versa. So to your point, just because we say knowing what you own is really important in making really good judgments when there is share price volatility.
I want to pick up on your get-evenitis as well. And I don't know who came up with that term, but I know we all use it now and then. But it's the idea that if you paid $20 for a stock and it goes down to $15, you want to get back to $20 and you just want to hold the stock regardless of the outlook. Tell us why that can be a mistake.
Well, I think there were some psychological experiments that demonstrated the pain associated with loss is twice as bad as the joy associated with gain. So when you are in a loss or in a losing position, you are incentivized to avoid making judgments about underlying fundamentals, and your emotions take over, causing you to want to hold on. The issue with that is the math rarely works really well. If you purchase a stock in 100, it gets cut in half. You need to earn 100% to get back even, which often, if there was a misjudgment, if a company's fundamental is not going to unfold the way you thought it would, that kind of response, that kind of gain might be a very unlikely outcome. And the best course of action would be to switch into a better opportunity.
Yeah, I think we could actually flush out an example here, and I'm going to bring up what's possibly a bad memory for you, but Valeant Pharmaceuticals was a big Canadian-based pharmaceutical company, I guess about a decade ago. I think it became the biggest stock in Canada in terms of market cap, and it started going down. Tell us how and we had recommended it. Tell us how you responded and what would have happened if you had get-evenitis in that case.
Sure, that's a really great example. And I'd say we learn, I think, a lot more from mistakes than we do for stocks that go up right after we purchase them. And that was a clear example of a misjudgment of the management team. We had some reservations going in about the management team and aggressive business practices. And when some new information came out that caused us to reassess the opportunity, we thought it was a little bit too bizarre and a little bit too confusing. And our reaction was, let's not wait for more evidence of potential bad behavior. Let's simply move on. Had to answer the question, had we adopted a get-evenitis mentality with the hope of getting back to our original cost basis or purchase price, we never would have seen it. We would have been holding on forever. And our opportunity cost in doing that would have been high because there were other companies that were performing well in that space.
It kind of ties us back to the switch to some degree, that you could sit there and try to get back to even on Valeant. And in that case, you never did. It was a bad idea. In fact, the stock actually went down a lot more after we got out of it. But we were able to take the proceeds from what we had in Valeant, a few lessons along the way as well, and deploy it into another idea, which went on to do a lot better. So I think the bottom line is watch out for get-evenitis. I do want to hit on the connoisseur. I believe you talked about it, but we might be able to wrap that in to the next discussion here. I wanted to hit the third point that you mentioned, which is overvaluation as another reason to sell. What does that mean, and how do you decide when something is overvalued?
I think the question around overvaluation is similar to what constitutes a great piece of art. It's often in the eyes of the beholder. Most people will look at PE multiples, and there are some heuristics or rules of thumb around PE multiples. Is 20 times expensive? Is 30 or 40 times expensive? More often than not, we will look to the bond market and look to interest rates. There is a relationship between the rate of interest and a reasonable multiple. However, at market extremes, some of those relationships no longer hold. So you have to be careful around that. Sometimes really great companies can go through stretches where they are overvalued, but over time, their fundamentals are growing and they're growing into that valuation. I mentioned before a book that influenced me, The Art of Execution. Phil Fisher, who was who was an investment manager who influenced Warren Buffett, wrote a really fantastic book. If you haven't read it, I would recommend going out to purchase it, called Common Stocks and Uncommon Profits. And he really helped, I think, Warren Buffett focus more on business quality in addition to price. But as it pertains to holding periods, I think one of his most famous quotes on selling is, if the job has been correctly done when a common stock is purchased, the time to sell is almost never. So when you have a really great business and you've determined that it has competitive advantages, a great management team, you want to hold on to that stock, even if the price and the valuation seems high, because over time, the compounding effect will be quite rewarding.
So that kind of ties in with the idea that you provided earlier around connoisseurs and letting your winners run. And I think there's a lot of people that have learned some interesting lessons over the past years in terms of watching winners run, because companies like Microsoft and Meta and Apple have, I would say, expanded well beyond a lot of people's expectations. And it would have been easy to trim and take profits along the way. But the best idea would have been to just hold on. But how long do you hold on for? And there's got to be some price that is too much. And just like this when to sell discussion, there's a lot of art involved. But I think back to, for example, the Nifty 50, which were 50 wonderful companies that peaked in, I think it was 1972. Companies like McDonald's and Coca-Cola, I think Xerox was in there. And they just got to be way too expensive. And it took you years to make your money back. And a couple other examples, the late 90s, we went through something similar. Coca-Cola in, I think it was 1998, peaked at a very high valuation multiple. It took 20 years to get back to break even. Microsoft, same idea, from 1999 to 2016, essentially went nowhere. So I like the idea of holding on to winners, but how do you avoid, a case like Coca-Cola where you had to wait 20 years to get your money back? Maybe it would have been better to trade Coca-Cola, sell Coca-Cola in 1998 or 1999, put it into something else, and you could try to buy it back later, maybe at a better price.
I wish there was an easy answer to that question, Steve. And I think for every example of holding on, there is a counterexample, and some of which you just pointed out. Microsoft has been a pretty instructive one for me, in that its share price peaked in 2000, and it took 14 years for the share price to reach its prior high, despite its earnings growing at a pretty good rate all through that time frame. So there is such thing as too high a price one can pay, even for a great monopolistic dominant business.
I think you're finding that the case with some of these technology companies today. We still recommend having stakes in Amazon and Apple and Alphabet, but at the margin, I think you're telling people to maybe manage their exposures a little bit based on potential. I don't know if overvaluation is the word, but just valuations are getting a little bit more stretched.
Absolutely. We've noticed when we first embraced these companies, they were reasonably priced given the value that you receive. They weren't as universally accepted or embraced as they are today. So as these companies have grown and now represent a very large part of the index, and as their market caps have reached astronomical heights, we're telling people that we still like these companies. We just don't love them as much as we did 8 or 10 years ago. And you want to manage your exposure to the high technology sector in totality. Make sure you don't want to be over-indexed in something that could be exposed to excessive price risk.
And at the margin, we can bring in this idea of the switch again. We're deploying some of those proceeds into very good businesses that are valued at much lower valuation multiples. We talked on a podcast a little while back about Fairfax Financial, and we deployed proceeds from a more expensive, more highly valued insurance company into Fairfax. We've bought shares or recommended shares in a company that sells equipment to gas stations recently that's trading. It's a really good business. It's just trading at a low valuation multiple. So there's a switch element coming in there as well. Last topic I want to hit, and it's related to the discussion, maybe a natural extension, is to talk about holding periods. And some investors buy and sell frequently. The average holding period for a US stock is now under a year, and it's come down a lot over time. And some are quite successful trading frequently. We've been successful by doing things a little bit differently. We tend to view stocks with a longer term lens. Our average holding period is more like 5 to 10 years. What are some of the advantages of this longer term thinking?
I think as more and more people focus on shorter term, whether a company is going to beat earnings by 2 cents next quarter, that's a really, really difficult exercise, and it's super competitive. When you're looking at a company on a longer term basis, you're really trying to assess the company's fundamentals and whether or not it can sustain its earnings power over time. So you're thinking about how the company might be advantaged. What are its products and service? Are the switching costs high? Who is running the company? Are they invested? Do they own shares in that company? How are they compensated? And I think when you're focused more on some of these more fundamental factors as opposed to short-term earnings performance, it's a far less crowded field of people doing it. And all else being equal, we'd rather compete with fewer people than more.
That makes sense. I would also add that it can actually provide opportunities to think longer term. What you just discussed is more a Warren Buffett style of investment. And you referenced Phil Fisher earlier as a teacher of Warren Buffett. Another one of Warren Buffett's teachers is a fellow named Benjamin Graham. And he taught us that the market is there to serve you, not to guide you. So if everybody's focused on the short term, and it can provide opportunity for the long term. And by that, I mean, a company might have a not great outlook for the next 3 months or 6 months, and that might keep a lot of people out of the stock and depress its valuation. But if you're willing to look and say, this is a really good company and it's going places over the next 3 to 5 years, and because nobody wants to own it for the next 3 months or 6 months, it could provide a really nice opportunity to go in and buy shares of that company at a good price. And you can take it the other way too, in that if everybody's jacked up on the next 3 months, but the longer term outlook or the valuation's a little bit murkier, it could be an advantage to potentially trim some of your position down as well.
Those are great points. And I think if you're focused on the long term, you're really trying to assess the earnings performance of a company as opposed to the short term where you have to incorporate sentiment. And we don't think we're really good at judging what the crowd might like or dislike on a near-term basis.
Yeah, I think it was John Maynard Keynes that maybe you'll remember the quote better than I can figure out the movement of the stars, but not the madness of people. I might have phrased that a little bit wrong, but it's hard to figure out sentiment, but you can hang your hat on fundamentals a little bit better.
I think that's right.
So thanks, Stephen, for joining us today. I think we'll leave it there. The sell decision is a very important part of investing. How and when you sell stocks will ultimately add or detract to your portfolio return. Unfortunately, there are no hard and fast rules on when to sell a stock, but with a general framework, as we discussed today, and lots of thought and discipline and experience, we can all endeavor to improve our discipline on when to sell. As always, thank you everyone for listening. Take care, and we look forward to talking again soon.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.